A home is more than its walls. It is a place of belonging. It is a source of stability. It is where life unfolds. But today, for many, the home has become something else. It has become a financial product. It is an asset to be traded on global markets. This process is called the financialization of housing. It means that the logic of high finance, investors, complex securities, now dictates who gets a home and who does not. It is a quiet but powerful force, reshaping our cities and lives, making shelter less secure for millions. This was not always the case. Housing and money were more local, rooted in communities. After the Great Depression of the 1930s, the United States built protections to shield families. Laws separated everyday banking from risky investment bank bets. The goal: keep people's homes safe from volatile markets. A home, foundation for a family, not a chip in a high-stakes game played by financiers. In the 1970s, the system began to change. Rules were dismantled. Interest rate ceilings were stripped away. Lenders could charge more for home loans. New complex financial products entered housing. 1983, Fannie Mae began issuing a new mortgage-backed security. Loans were packaged and sold to investors worldwide. Local housing markets became tied to global finance. This was a deliberate policy direction. In the 1980s, savings and loan institutions collapsed. Government intervened, often prioritizing the financial system over homeowners. Troubled loans were moved off bank books. Private firms bought these loans in bulk. Precedent set, state absorbs bank risk, families bear consequences. Tax policies and incentives then encouraged capital into real estate. Housing became a premier investment vehicle. The 1970s marked a turning point. Decades of regulation were slowly unwound. This process, known as deregulation, was promoted as a way to make markets more efficient, but it also introduced new levels of risk into the housing system. The Depository Institutions Deregulation and Monetary Control Act of 1980 was a key piece of this puzzle. It removed the caps on interest rates that banks could charge on mortgages. Suddenly, the cost of borrowing was no longer tied to local banks, but to national and international markets. Home ownership became more expensive and less predictable. The invention of new financial tools was just as important. The mortgage-backed security, or MBS, was the most significant. An MBS bundles thousands of home loans into a single product that can be sliced and sold worldwide. It turned a local family's purchase into a global commodity. Investors could profit from housing without owning a property. This new system accelerated after the 2008 financial crisis. The crisis was caused by risky bets on these very mortgage securities. Millions of families lost their homes to foreclosure. In the aftermath, the federal government had a choice. It could have helped families stay housed. Instead, it chose to help the banks. The government facilitated the sale of hundreds of thousands of foreclosed homes in bulk. The buyers were not families. They were large private equity firms and institutional investors. They saw rock-bottom prices and turned them into rental portfolios. The government actively encouraged this transfer of wealth. Tax policies favored corporate landlords, allowing depreciation write-offs, lower taxes, higher profits. Complex structures could shield earnings. Meanwhile, public support for affordable housing was cut. When large investors buy up housing, they do not act like traditional landlords. Their responsibility is not to tenants or communities, it is to shareholders. Their goal is to maximize returns. This focus changes the rules of the rental market. Scale and resources extract value through rent hikes, maintenance cuts and fees, late or administrative. Strategies vary by market. New York, San Francisco investors target rent-stabilized buildings. They push out long-term tenants, protected by lower rents, with aggressive evictions, neglected repairs, and small buyouts. Once vacant, rents jump to market rate. Profit now. Affordable housing is destroyed one unit at a time. In Sunbelt suburbs like Atlanta, Phoenix, and Charlotte, investors bought tens of thousands of homes after the foreclosure crisis. Owner neighborhoods became rental portfolios. Leases shift costs and risks onto tenants, standardized and non-negotiable. Tenants may handle repairs, lawn care, even appliances, enforced by remote managers hundreds of miles away. When things go wrong, renters have little power. In weaker markets, older industrial cities and rural towns, investors use predatory instruments like land contracts, contracts for deed. Families pay monthly without equity or title until the final payment. Rates are high, terms harsh, and homes in poor condition. Miss one payment, the seller can evict, keep all paid, leaving families homeless with nothing. Decisions shift from neighbors to distant executives. The single-family home becomes recurring revenue for global investors. Financialization is not abstract. It has a devastating human cost. When housing is an investment, residents become secondary. Profit-seeking drives instability. For corporate landlords, eviction is a business tool. Remove those who can't pay. Replace with those who can. Research shows large corporate landlords file more evictions, often for small amounts. Instability uproots families and harms children's education and health. High prices are not just supply and demand. Scarcity is often manufactured. Investors hoard housing, warehousing units off market. Developers release supply slowly to keep prices high. Austerity hollowed out public housing. Only 1 in 4 eligible families get vouchers. The increasing dominance of financial actors on American housing sector favored speculation, blocked affordable homes while greenlighting luxury.